Hi guys, well this is just the follow-on video to our lecture on accounts receivable. We have just a couple more slides, so this seems like the best way to finish that out and give you time to complete your homework this week. Speaking of homework, just a hint on question 15 through 21, which is a comprehensive problem. The tricky part really is estimating what will be the adjusting journal entry for the allowance for your uncollectibles. I suggest setting up on paper outside the problem both your accounts receivable T account and your allowance for uncollectible T account. Make sure that you have the beginning balances that are listed there for you in the problem, and then make sure you capture each journal entry that you're writing, including that write-off one. And this is just a side hint that when you're done, the balance in your accounts receivable should be $15,000. Make sure you can get there, and then you can look at the data they gave you about aging that and hopefully come up with the correct adjusting journal entry for the allowance for uncollectibles. The other hint for that problem is just to make sure that you have updated your retained earnings with the information that you calculated in your income statement before you try to write the balance sheet. Okay, so those are the homework hints. Just a reminder of where we were. We had looked at this example of Skechers, where we had, by aging all of the different accounts, we had identified that what should be in the allowance for uncollectibles was $7 million. Right now, what was in our allowance for uncollectible account was about $4 million. So we needed to write an adjusting journal entry. And the adjusting journal entry, and again, this would be allowance for uncollectible accounts in our textbook, $2.8 million. And the offsetting account would be bad debt expense. This allowance for doubtful accounts or uncollectible accounts is a contra asset account. It belongs with the accounts receivable, and then the bad debt expense will show up on our income statement. Bad debt expense, the estimate we're doing here is based on our balance sheet, that we're getting the balance sheet to reflect the allowance for uncollectibles and what we believe will be the net cash that we receive, so the accounts receivable, less the allowance for uncollectibles. We're trying to tell our investors and creditors how much cash we think we're going to receive, and then the offsetting amount will be on the income statement and bad debt expense. We're not estimating bad debt expense directly. We're estimating it based on our aging of accounts receivable. All right, so that's the finish of our allowance for uncollectibles. Another topic that we cover in Chapter 5, this is a review. We have done another problem like this, but just a review in these short-term or current asset parts of our balance sheet. We're going to look at notes receivable. So an accounts receivable is usually something that we've sold some goods or services to our customers. We don't charge interest on that. Usually, we give them 30 days to pay off that amount. We don't charge interest on our accounts receivables until they're past due. But a notes receivable, where we have lent money to someone, they will start generating interest the day that we lent the money. So when we're calculating interest, just a reminder here that interest is a function of the principal, how much we've loaned, times the annual interest rate. And our interest rates will be quoted annually. Doesn't matter if the loan is 6 months or 3 months or 18 months or 30 years. The interest rate that's quoted would be what the interest would be for an entire year. And then we multiply how long that loan has been outstanding. So here's our example for Skechers. Skechers loaned $100,000 cash, and they've accepted a $100,000 one-year note at 12%. So that's the annual rate. And this is a little unusual. Often when we do these notes, we'll be getting interest monthly, but sometimes we'll do it this way, and this highlights our concepts about accrual accounting. In this particular loan, the interest and the loan amount will be due at the time that the loan is due, on the 31st of October. So here we have it. We have loaned the money on the 1st of November. We have to do our financial statements here at the end of December, and then we'll get all of the interest and the loans back here in October. What happens here in these 2 months between November and the end of December is we are accruing interest. We have loaned them the money. They have use of the money. We are earning interest during this time, even though they are not paying us the cash. The cash will happen out here in October, the end of October of 2008. We're still earning this money. They can't just give us back the money here, let's say on the 30th of October, and say, oh yeah, well, look, it's before the due date, so we don't owe you any interest. They owe us interest. It's just a question of when we're collecting the cash. So we're going to accrue for that interest that is earned. With a 100% cash note, 12%, at 12%, that would be 1% per month. So when we record this original loan, we'll go ahead and write the notes receivable. That's the debit. This money is owed to us. And then we have given them the cash. So that's why the cash is a credit. When we're doing our financial statements at the end of December, we'll have to identify how much interest we have earned. Even though we haven't been paid cash, how much interest we have earned. So here's the principal of the note, $100,000 times 12%. That's $12,000 a year. There are 2 months that we're talking about. So the interest that we have earned is $2,000. The interest revenue is $1,000 per month, right? We earn $1,000 per month. So the way we would write this adjusting journal entry at the end of December is that the interest receivable is $2,000 and the interest revenue is $2,000. We have earned it. We are owed the money. We have not gotten it yet. At the end of the time period, in October, this interest receivable, so remember, here's the interest receivable. The money is owed to us. The money will no longer be owed to us. We have 10 months of interest revenue during the 2008 time period, not 2007. This is from 2007. Here's 2008. And we get the $100,000 back. So the amount of cash that we're going to get back is $112,000. All right. Last topic here, receivables turnover. One of the things that companies are interested in and understanding is, are they doing a good job of collecting the money that is owed to them? And that's called the receivable turnover. How many times, in any given year, are you collecting your receivables 1 time a year, 2 times a year, 12 times a year? Like what's the throughput of these receivables? So here we're going to look at a ratio that is the net credit sales. How much are we selling on credit, on accounts receivable, and how much is the average receivables. So let's just do this example. Here's the credit sales are $1 billion. Is that right? Yeah, $1 billion. And then the receivables 134 million and 120 million. We're going to average those together because here's this credit sales revenue, that's from the income statement. These are from the balance sheet. This is a moving picture. These are a couple of snapshots. And let's just talk about what this means. So this means that the total receivables have moved through Skechers a total of 7.9 times. So they've collected all of their receivables 7.9 times in any given year. Well, compare that to Boeing has collected 11 times. That's better, right? There's more receivables going through Boeing than there is through Skechers. Deere & Company is slower than we are. This is a little confusing. What we often find is better to talk about how many days on average does it take us to collect our accounts receivable. And what we're going to do is we'll just take this 7.9 times and we'll divide it into 365 days. What the receivables turnover days to collect is telling us is that on average, it takes Skechers 46 days to collect their accounts receivable. Is that good? It depends. If we compare it to other companies, Boeing, which had 11.1% turnover ratio, right? They collect their receivables at about every 32.9 days, 33 days. That's faster than we do. But Deere & Company, John Deere, the guys that make the big tractors, they collect their receivables almost every 60 days. So we're somewhere in between. What I'm really interested in is looking at other what's Adidas doing? What's Nike doing here? And comparing it to how were our receivable turnovers last year? Like, are we slowing down? Are we speeding up? Is there a problem? It depends is the core answer here. So that's it for my lecture, my short lecture today. And we'll follow up any additional questions people have on Monday or Tuesday. See you guys. Hope you have a good weekend.